Good morning and welcome to or good afternoon, I guess I should say, and welcome to the second day of our January Illinois Soybean Growers 2026 webinar series. Today, we're going to follow up on the presentation from yesterday, reevaluating your on-farm investments. Some quick logistics. I'd like to invite folks as the presentation goes forward to use the Q&A function to submit questions, and we'll get to those at the end during a Q&A panel discussion. With that, Gary or Nick, I'd be happy to hand it over to you.
All right, thanks, Corey. And for those of you that were with us yesterday, welcome back. And for any new attendees, thanks for joining us. So Gary and I are gonna kind of approach this one the same way we did yesterday. So yesterday we tried to focus on talking about decisions related to cash rents. Today we're going to shift focus to some on-farm investments. And then again, a reminder to everybody that this is a part of a three-part series. So tomorrow we'll be back and talking about the farm income mix and looking at some alternative ways to bring in some income, particularly in the challenging times that we're in right now. Um, so today we are gonna do a little bit of a repeat on the front end of some of the material we covered yesterday. Again, we're assuming not everybody on today was with us for yesterday's webinar. For those of you that were, sorry for the maybe 10 minutes or so of kind of repeat here, but we think talking about sort of the current return and income situation that we're in is important to provide the context as we get into some of these other topics. And then Gary's going to talk about some things related to machinery investment and making decisions to maximize profits rather than yields and things related to that. Then I'll take over again and talk a little bit about farmland, and then hand it back over to Gary to kind of wrap up with some thoughts on some other investments. And then we'll have Ryan join for some thoughts and reactions, and we'll get to some questions that I think Corey will moderate there at the end. So again, I'll try to go through this quickly, and if it feels quick, it is. There's a lot of information here, and if seems like I'm rushing, I am going to rush through it. But again, the recording from yesterday would provide a little bit more. Still probably fairly rushed because it is a lot of info, but a little bit deeper dive into some of this first section material. And so what we opened with yesterday was we talked a little bit about where we're at in terms of prices. And so, the main message here is that we are, dealing with lower corn, soybean, and wheat prices than we have been in some recent years, coming off the highs that we reached in the 2022 marketing year. We're now looking at corn in that $4 range, beans in the mid $10 range, wheat around $5. And then looking ahead to 2026 crop and marketing years, maybe a little bit of reason to think that we'll see slightly better prices for the upcoming crop, but not significant increases, and definitely not a return to some of the prices that we saw in the 21 and the 2022 marketing years. So, low prices is kind of part of the story that we're dealing with. But we always also like to emphasize that when we say low prices, they are low relative to the cost that we currently have. They're not low relative to sort of longer term planning averages that we think, kind of the global market fundamentals would still say we should be hovering around. And so this just kind of gives you a little bit of a historical look, a reminder of where we've been. And I think most ag economists, most farmers would agree we probably saw a change in what that long-term planning price would be as a result of the ethanol build in the mid to late 2000s. And since then, we've been kind of hovering around that mid $4 range for corn, mid to slightly higher $10 range for soybeans. And so again, coming off a 654 price in 22 for corn, a 1420 price for soybeans, those are probably not the prices we should be building into expectations or budgeting exercises as we're trying to pencil things out for future crop years. We might currently be a little bit below those planning averages, but not anywhere below them that we would say is sort of out of the realm of kind of normal possibilities, given where we think those longer term averages are going to hang around here moving forward. I mentioned production costs again. That's sort of the second piece here that's really creating the challenges that we're facing. So we saw those price spikes in 2022. Our production costs, when we look at FBFM farms in Illinois, and this is combined kind of an average across corn and soybeans that we're looking at here, we saw the big increases from 2020 to 21 to 22 and then peaking in 23. We have seen those costs come down a little bit, about $75 or more per acre here for farms in central Illinois on average. About two-thirds of that decline is in the non-land cost category, largely from some lower fertilizer prices relative to those spikes we saw in 2022. And the other third is some softening in cash rents and some lower cash rents that we're seeing, at least on average, that we went into more detail on yesterday. The challenge here is that we've got prices that have kind of fallen back to levels we were at 2019, 2020. Our costs have come down as well, but not back down to those cost levels that we had 5 or 6 years ago, still remaining elevated above those levels. And so that's resulting in in a lot of the negative return projections that we've seen and the negative returns that we've realized on average since 2023. Again, real quickly, we also wanted to again mention the fact that we did see some significant changes to both the commodity title and the Farm Bill, as well as our crop insurance program in the One Big Beautiful Bill Act that was passed this past summer. And those changes significantly increased the payment potential for those ARC and PLC programs, basically a doubling of what we might expect to see in terms of payments for those programs relative to the 2018 Farm Bill design for those things. The challenge on those is that we're not going to see payments associated with the 2025 crop on those improved programs until October of this year, given how those things work and the delay that we see in those payments. Crop insurance, we are going to benefit from some of those changes a little bit sooner here as we make crop insurance decisions for 2026. In general, we saw some increases in premium support. And the big one that we're making sure producers are aware of and taking a look at when they think about their 2026 crop insurance coverage is the significant increase in the subsidy rates for those county add-on products. So the things that you could combine with your underlying RP coverage, the SCO and ECO programs that are now subsidized at 80%. We're not necessarily saying it's an automatic decision to purchase those, but given that level of subsidy, definitely something to take a look at and offer some opportunities to manage your crop insurance coverage cost on the premium side and still have some pretty significant coverage by combining some programs together. And then the third point here is again between now and when we're gonna potentially see those improved ARC and PLC program payments in October. We've got the Bridge Assistance Program that was announced in December and more information provided in terms of payment rates on the 31st of last month, end of the year. Similar to the ECAP program that we had last year that was associated with 2024 crop losses paid in 25. We've got the Bridge Assistance Program that is designed to offset some 2025 losses, and those things will be paid here in the next 6 or 7 weeks here in 2026. And the support levels we're looking at in that Bridge Assistance Program for the crops that are our main focus here in Illinois, $31 per acre on soybeans, $39 per acre on wheat, $44 per acre for corn acres. These are going to be paid on planted acres. Some of you may have already even contacted or worked with your local FSA office on these things. We're being told that they've got pre-filled applications for everybody. should be a fairly smooth and hopefully quick process to get those payments issued out based on your planted acres from last year, and definitely will contribute to some improvements in those 2025 return numbers that we track. Um, Another thing we'll just real quickly mention that we talked about yesterday is um, sort of this shift back towards kind of a reliance on some of these ad hoc disaster programs. And so you see the bars there in orange represent kind of the amount of federal support that have come from ad hoc disaster assistance compared with the green bars, which is our commodity programs, ARC and PLC. Big support in 18, 19, and 20, largely from the MFP program, as well as some of the COVID pandemic programs that we had. 2024 there is ECAP, and then 2025 is basically an average of those corn and soybean payment rates on that bridge assistance program. So, the messaging here is ad hoc has been playing a pretty big role in the last decade. If things continue on the same path that we're currently on, we'd expect that to continue, but there's no guarantees there. And we could probably talk for an hour about whether that's a good thing or a bad thing, short term versus long term. But it's kind of the situation that we're in right now. So again, just kind of wrap this up quick, and then let Gary get into the today's specific topics. But again, federal support's playing a big role here in recent crop years in terms of uh, limiting the amount of, I guess, financial damage that's being done by some of these poor returns that we're seeing. Couple of points to make on this slide that we use quite a bit. One is, the variability in these net farmer returns on cash rented farmland that we're looking at. We've gone through periods of poor returns, multi-year periods of poor returns in the past. The late 90s, early 2000s were not great years. We had a tough run from 2014 to 2019. But just the magnitude of some of those negative numbers that we've seen since 2023 is historically a pretty big deal in terms of the poor return performance. The other point I would make there is that $100 there that we see for the 2025 crop year, that's again the bridge payment that we just talked about, plus what we would put as an expectation for that ARC and PLC payment we might expect in October. We're looking at about $100 per acre for Central Illinois in terms of support, federal support from commodity title plus ad hoc. And, that's just kind of getting us back to that, $19 per acre average return there. So, definitely helps, but it's also not turning a bad situation into a good situation. It's just covering what would be a considerable loss in the absence of support from both of those sources. And then looking ahead to 26, nothing built in there yet in terms of ad hoc, but a pretty sizable ARC PLC payment we would be projecting for the current crop year. Wouldn't be received until October 2027. But again, would be a much more negative return number there in the absence of that ARC and PLC payment, as we look at the outlook for the current crop year. All right, so again, just kind of setting the stage here for what we're going to talk about. Again, we've got people talk about dealing with low prices right now. They are low, but they're also kind of where we think that prices could hang around for the foreseeable future. And really the challenge that we're facing because of those price levels is some of those big cost increases that we've seen since that pandemic year of 2020, and what that has done to our break evens given those costs of production. There will be another set of years or a year at some point in the future where we do see some good profitability again. But we could also hang out in kind of the environment that we're in for the next 1, 2, 5, 10 years. We've seen it in the past, and it definitely could continue. And while these government payments have been kind of important, sources of additional revenue. Kind of the downside of those is they are a relatively short band-aid solution, and they're probably slowing some of the longer term adjustments that we need to see to get us back into more of a sustainable, profitable environment from an economic standpoint that we'd like to be into without having to rely on those federal payments. So again, I rushed through that, but I'm gonna turn it over to Gary to talk about some machinery investment decisions.
Okay, so let me share my screen here, and now we're going to begin. That's the environment we are in. Nick described that environment. Now we're going to talk about some of the responses to that environment, and we're going to start with machinery investment. Farmers have forever, probably, or at least my lifetime, which in my case is forever, but um, make purchase more when incomes are high. And we can see that here on this graph. We had relatively high incomes in 2022, 21, 22, and we saw machinery and building purchases increase. That makes a lot of sense. There's cash flow there to make those investments, as well as there's tax incentives to make those investments, and with bonus depreciations and quick write-offs, we can reduce taxes for that reason. Now we've entered a lower income period here, 2024, 25. We're making a projection here in 2026. We're looking at higher incomes for 2025. By the way, that higher income includes $100 of receivables on that. So this would be an FBFM number, and it would include our PLC payment, which we would be projecting for October, as well as those farmer bridge payments. So there's a lot of non-cash items on there. Anyway, doing tax planning, or that's already done. We're likely to see machinery investments again fall, and building investments fall, probably getting back here to that 2014 or 15, 16, 17 levels. Again, that's just what we see farmers do when we have lower incomes. What makes this time a bit different, also besides the negative returns we see, particularly for cash rent land, is just how much equipment prices, and all prices for that matter, increased, particularly in 21, 22, and 23. Those years were coming off of COVID, and COVID changed the world. um, um, Everybody, including the equipment manufacturers, face labor issues, and every item seems to have gone up. And we saw those prices go up considerably in 2021 and 22, 23. Less so in recent years, but looking back at this, you don't ever see those prices come down. And we wouldn't expect those to come down this time either. Maybe we'll see some slowing of the increase. But overall, we got up to a much higher price level. What that then does is makes those equipment decisions more of an issue. We always see those machinery values go down as we increase the farm size on average, and that's a key word. On average, you can do certain things to make those go up, but on average, machinery values and costs tend to go down when farm size increases. But that's not a guarantee either, because we do need to match the machinery complement to size to acres. And a strategy of increasing acres right now, given what we're seeing for the returns from cash rent farmland, I mean, you could increase cash rent farmland, maybe drive your costs down some, but we're still probably looking at negative returns um, without ad hoc federal payments. So that strategy um, isn't necessarily a financially sound strategy now, given this current environment, and particularly if we're getting that land at a high cash rent. And if some farmers get some land, acquire some land for high cash rent, you actually might have made the financial situation worse for the next couple of years until something happens to prices, and then it becomes a issue of can we last till the next time we see higher incomes. Again, what we've seen is all of those costs go up. This just shows for corn, machinery related costs. Depreciation has gone up. You can see that those increased, particularly in years in which we've made purchases. They do come down, but not very slow, um, not very fast, excuse me. They're slow declines. The other thing that has happened over time is that repair costs have gone up. Um, and again, we don't expect those to come down. Every machinery dealer has issues finding labor, and parts haven't gotten any less expensive over time. So even though while we've also increased our machinery complement, our repairs haven't gone down, and if anything, they've sort of escalated in recent years. And again, that's part of the environment. So now let's talk about some things. And none of these are very pleasant. So just we know that. So just we know that. So I'm going to go through some investments here. We're going to talk about combines, tractors, and then planters. So let's just talk about combines first. Every other year, we estimate the cost of operation given new equipment, and these are the curves. This is the 2017 curve right here. So if you had 2,200 acres, we would have estimated the cost of about $40 of operating machine given 2,200 acres, and as you increase those acres, those costs typically go down. You can see there's a 2017 line, 2019, 2021, almost the same as 2021, 2019. Those two are the same. And then we have this large increase in between 21 and 23. And there's a couple of factors that have gone into that, but it's primarily higher equipment cost. And again, we saw those large increases from 21 to 23. And again, a continued increase in 2025. Again, we've been doing this for several years and we've never seen them come down. So they just keep going up. All right. Here's the thing that these curves have always been lower for larger um, um, acres through the combine. Those and here what we're doing is spreading those fixed costs of owning that machine over more acres. And that's primarily why they're going down. You have some countering of that in repairs going up, but the spreading those ownership costs over more acres. All right. Now we've reached the point 23, 25, where the cost associated with operating less acres have become, the difference has just gotten large, right? And you can see here at 1,800 acres, we're looking at something at $75 versus something at 3,000 in the still high $50 range, but we're looking at a very large difference. And again, this isn't to, so when anybody faces their next decision, their replacement decision, that's when these things have to be looked at. Until you replace it, you got those costs, and it's the replacement time where you can change those cost curves. Just to give you a feel here, we always do this with 3 different types of machines, and smaller versus bigger machines make a difference as far as cost, but it's still um, mainly the acres operated that make those difference bigger. Again, these figures that we're shown, we do those machinery cost estimates, and they're included in new machines. You could reduce those costs by looking at used equipment, but used equipment has lower ownership costs and then likely higher repair costs. So there are some trade-offs here. Anyway, you're looking at these costs, and simply put, if we're looking at a newer combine, we have to operate that over something in Illinois and the Midwest, over 2,500 acres to get most of the cost. And that's not going to change. And again, owning a used equipment may reduce that, but still, the complexity, size of these new machines, we're looking at 2,500 acres. And if we're less than that, we gotta, this is the favorite thing of economists to say, cooperation. and again, we know there are a lot of issues with that. But we do see some larger 3,000 plus acres combining, and say 3 of those, 3,000 acre farms, rather than having 3 machines, having 2. And again, it does reduce cost. And again, we are in this cost environment where you have to look at everything. And so thinking about ways of getting more acres out of that combine, and thinking about 2,500 acres for a relatively new machine, and actually 3,000 would be probably a better number, but getting those acres up there through that machine. Tractors. All right, tractors cost a lot of money. And here's actually, these costs are a little bit old. They're probably more than this that I'm putting on here. And here's what I'd say about tractors. And we don't care about 20-year-old tractors. We're talking about relatively new tractors. And if you have a farm, 2 versus 3, 3 versus 4 make a big difference. It just does. And so, and we can look at through data and see those differences. So minimizing the relatively new tractors on a farm are going to reduce those overhead costs. Again, we're just taking a machine and running it over more acres. And 2 versus 3, 3 versus 4. So again, thinking about our larger size or newer tractor component, and thinking about ways of, can we cut one? And that will again have a significant impact on cost. Number 3 is planters. And in the Midwest, in Illinois in particular, we've seen a lot of operations by 2 combines, and had 1 devoted to corn and 1 to soybeans, and go. And we and by the way, planting early soybeans is a very good strategy. We know that planting early has good yields. So but the 2 planters have gotten more costly. And here, just to illustrate this, this happens to be a 24-row planter, and we look at the cost of operation with the cost estimated in 2021 is $15.40 for a 2,500 acre farm, $19.20 in 2023, and $21.40 in 2025. Again, we saw that big increase in 2023. Well, if we have two 2,500 acre farm and have one devoted to corn to soybeans, and they're both relatively new, we would have been from $15 to $24 in 21, and in 2025, which is $9. Now we're up to more. All right. And you can do the same thing with 5,000 to 2,500 acres. Again, there is a large advantage of planting early. There's absolutely no doubt about that. And planting early is in most years, will have higher yields and higher returns. But just given the cost increases that we've seen on planters and all equipment, that 2 versus 1 probably needs to be reevaluated. And again, take a look at that. You still should be planning early. So work that out. I know that's hard. Turning next, our next sort of strategy is maximize returns, not profits. And now we're switching from machinery more towards that fertilizer, pesticide, and seed. Here we're showing fertilizer, pesticide, and seed go over time. Generally, we've seen all those go up. The most variable of those is fertilizer. And we've seen that come down from 2022 to 24. And we're actually projecting higher fertilizer cost in 2026 because of higher fertilizer prices overall between 26 versus 25, as we're seeing here. So we've seen those costs go up. We have high cost, lower prices. Okay. The cost of maximizing yields have gotten higher. Here's just an observations that we see from PCM, which is Precision Conservation Management. It's a program where we collect data on field passes on Illinois, Kentucky, Nebraska farms. They're pretty much all the same as in this observation. They're not the same in what they do, but this observation. Most farmers have one production plan that they use on all their fields. And if we look at Illinois farmers and we look at cornfields, and most of our cornfields in the central part of the state would be soybeans, followed by corn. And northern, it would be different than that. And southern, it would be different than that. But those fields that follow the same rotation, 88% of them do the same thing. So they go in, use the same tillage practices, use the same nitrogen strategies, use the same nitrogen rates, and that makes sense. We're doing the same thing to each field. We got a formula, and it works. And that plan does not change much from year to year. And I would say that it's very easy, particularly when we had that $6 corn and higher prices. There's very easy for this plan to maximize yields. We did see some rates go up during that period. Well, just to give you a feel, again, university, if you look at MRTN and what the agronomists at the University of Illinois say, they would say that on corn, we should be applying somewhere in the rates of 180 pounds per acre in northern and central Illinois. This shows over a 5-year period what the number of fields that in PCM that fall in those ranges. Here's what happens to average yields. We get 218 and 220 bushel yield for these. You'll note that the yield does go up. However, returns don't. And what we're seeing here is that the yield increase isn't compensating enough for the additional nitrogen and some other factors going on. So we're getting higher yields, and it's important to get high yields. But 220 versus on average for the last 5 years versus 223 or 229, this is still a very good yield, but we're not maximizing those yields. And so, looking at MRTNs for nitrogen, looking at soil test levels for P and K, and if we're above those soil test levels or those maintenance soil test levels, cutting our rates way back would maximize returns and not maximize yields. Overall, and we've done this a number of times, is that when we look at profitability, we see that the higher profit farms have lower cost. And you can see this here. Building, other labor, crop cost would be fertilizer, seed, chemicals. Power is the machinery items we talked about. Land includes land rent or cash rents. All right. And those and the this is the difference between cost savings over time from our high cost producers. When we look at PCM, we see the same producers have above university nitrogen rates, also have higher pesticide costs, and have more tillage practices. So again, all right, you're planning the 2025 production plans. Think about those maximizing returns and not profits, and cutting back on those input decisions. Again, it's easy to get in a maximizing yield standpoint versus a maximizing yield standpoint rather than maximizing return. All right, now we go to our next topic, and Nick, take her away with farmland. You muted yourself, Nick.
We'll hit the farmland topic here relatively quickly here as we wrap up. Partially including this because it addresses some of the discussion we had kind of towards the end of yesterday's webinar, and hits on a few points that I think we talked about, and provides some numbers related to that. So the first one related to farmland here is we talked yesterday. I think Gary made the comment about owning farmland versus renting, farms with a good owned land base, particularly if it's paid for, are really in a much better position to kind of weather these multi-year runs of poor return performance, and owned land can really help subsidize some of that high cost rent land in conditions that we're in right now. And historically, I think we mentioned yesterday that farmland from an investment standpoint has compared quite favorably to some alternatives that you could put your money into. Obviously, farmer investment in farmland, it's a required input for what we do in row crop production. But there's even interest, outside of farmers in terms of investments in farmland, and so they definitely look at comparisons like this when they're looking at deploying capital. And kind of just the main point here is that if we look at the last 50 years in the middle column here, or the last 30, 35 years in the right column, just comparing kind of overall return performance on farmland in the Midwest or in the U.S. more broadly with the NCREIF Cropland Index there, we are looking at returns that exceed kind of what might be viewed as comparable investments, or even maybe higher risk investments in equities, even if we're looking at some of the broader indexes like the Dow or the S&P 500. The challenge here in looking at these overall return numbers is, this is a big chunk of that, the majority of those 9%, 10% returns to farmland are the capital return, the increase in land value. And from a farmer's perspective, I don't know if I've ever met a farmer that's said they're interested in selling farmland. And so, actually realizing some of those gains is the challenging part. And being able to realize those gains, even post farming career is kind of a challenge. Um, but still, having land values increase, it's the biggest component on virtually every farm's balance sheet. And so it does provide financial strength and financial security from that perspective. And we have seen farmland values basically increase through time. Obviously, the 1980s crisis is the one counterpoint to that statement. We do see periods where land values might decline slightly or plateau. But in general, we've seen a pretty steady increase in land values, larger increases when we've got good profitability conditions, smaller increases or slight declines when we've got poor profitability conditions. And we're starting to see that in some of the land value numbers that we track here. And so these happen to be from the Illinois Society. And from 23 to 24, we did see a leveling off in the good productivity class, continued increases in average and fair, declines in the excellent class. 24 to 25, we're looking at kind of similar patterns, and then expectations into 26. We talked about this a little bit yesterday. Are moderate declines, maybe in the 3% range across all of the land class values, but still pretty continued strength in terms of the land value market. We also wanted to just make people aware of an article that we put out on Farm Doc Daily back in October of last year. Got some attention, and basically we sort of looked at, how have things changed over the last 20 years? If we're in the situation of trying to pick up an 80-acre parcel back in 2005 versus 2025, and just sort of what has changed in terms of the cash flow requirements associated with a land purchase decision based on the increase in values. We're kind of in a similar interest rate environment that we were in back in 2005 in terms of what kind of interest rates one might be able to get on a 20-year fixed real estate loan. And so that's not really driving the differences here. It's more so the significant increase in land values that we've seen. So for good to excellent land in central Illinois, we were maybe looking at a $5,000 per acre purchase price in 05. That'd be more like a $16,000 per acre purchase price now. And that is just translated to a more than tripling. The more than tripling in land values is translated to a more than tripling sort of in the initial and then also ongoing cash flow requirements to finance that land purchase. So just again, the sheer number of dollars that are needed to be able to actually make one of those investments. We still think that, we talked about this yesterday, we still think that buying farmland is something that should be the goal of farmers as they move through their farming careers. But I would argue that it's probably very, very few historical cases where it's maybe been more challenging than what we're currently facing right now. Again, just because of the amount of dollars involved in that. And then so as we wrap up here, and Gary should chime in and comment here as well, but kind of wanted to provide a little bit of a segue to some of Ryan's comments as well. So if we're not supposed to be investing in machinery right now, we need to limit our input use and try to get costs down as much as possible. The other sort of piece of advice we would give farmers now is to really focus on investments that can lead to increased returns, ideally in the short run. And a couple examples that we've written about and we've sort of talked about with groups in the last couple of years would be both drainage tile and then grain storage. On the drainage tile front, there is some pretty good research out there that shows that there are can be some pretty significant crop yield improvements, even in the relative short run. And that does translate to positive returns on the investment required for that drainage tile. And then, on the storage side of things, it's not necessarily something that's going to lead to increased profitability under all conditions in every single year. But it does provide you with that flexibility to be able to capitalize on some of those marketing opportunities that do generate a positive return to storage under those market conditions. So, Gary, I don't know what other points you wanted to make on that
No.
before we get into
You hit it. Oh, I'm sorry. Sorry. No, you hit it very well, Nick. Exactly right. I would again say, um, you know, you have to take into when you're looking at particularly at these sorts of things, you have to look at your cash flow and your working capital and where you're at. If you're not in that position, these would not be the time to do it. But again, on both of those, we do see we do see situations in which they do increase returns, and we would again, the grain bin side of it, in particular, a person that is going to go that route needs to realize that there's management time and involved in those decisions. So it's not for everybody, but if that is something that you can consider.
All right. So with that, I think we'll flip to the end here and did want to provide the QR code here. Corey, I don't know if you have some information related to that you want to give to the audience, and then we'll turn over to Ryan.
Yeah, thanks so much, guys. I really appreciate the presentation today. Again, talking about investments and infrastructure and equipment and how guys can think about that. For those of you who need CEUs, you can use the QR code on the screen at this time and get those CEUs, or you can email our membership engagement manager, Ashley Berry, and she'll help you with that. With that, I do want to transition to our Q&A. And we're going to be joined by Ryan Thompson, who is the Strategic Accounts Manager for AGI. Ryan works with farmers on grain storage and on-farm systems. And, we've had him on Illinois Soybean Grower webinars in the past, and he brings a practical view on investments that actually pay. And so I think we're just going to incorporate him into these questions. And I think we're going to jump into the questions. We have a few questions from yesterday that I'm going to kick to Gary, you, and Nick first. While we're going over those questions, I would just again invite anyone who is interested to submit questions using that Q&A function on their Zoom screen. So the first question that we didn't get to yesterday, this is kind of coming from this reevaluating our economics from a little bit different perspective. When income increases, we deal with income tax issues. Thoughts? Gary, Nick, that might be a little bit outside of your ballpark, but do you have any thoughts there?
So, all right, here's what we observed farmers do. They would prepay expenses, which does make if you particular well, we're past things that you can do for 2025, but prepaying expenses would be a way of doing that. Delaying grain sales and also then buying machinery. The issue that we sort of see is that once you begin doing it, it's hard to unravel it. So let's say you're delaying grain sales. Well, it may not be in the most profitable interest to delay it, particularly if you're going into commercial storage. You may be taking a high drop charge in Illinois. So ag economists get a bit concerned about minimizing taxes without and then once you start it, it's hard to stop. So that,
Yeah, and I mean, I think what the situation that a lot of farmers have found themselves in after, the last 5 years is, you take advantage of accelerated depreciation on a machinery purchase, but maybe you're financing that at the same time. So you get a very short run tax benefit, which is cents on the dollar, but then you're kind of, you're committing to, outlays associated with financing that purchase over multiple years. And now we're in years where, you might wish that you had those dollars available in working capital. And then, on delaying grain sales, I think, we sort of we got into about a 2 year period. I remember very clearly August of 2020, and I think Gary and I put out our crop budgets, and it was kind of a sky is falling type situation. And then we basically went on a 2 year run where the best time to sell grain was tomorrow. But following that 2 year period, now we've basically been in a 2+ year period where it's been the opposite. And so, I think now is maybe a little bit of a good time for reflection to convince yourself that delaying some of those grain sales, to maybe avoid some taxes, the risk of having those inventory values decline probably could offset the tax savings that you generated in one of those previous tax years. And it's hindsight's 2020. But I think kind of those lessons can be useful to think about strategies moving forward.
Ryan, just hearing those responses, I was kind of thinking in terms of maybe we're not looking at avoiding income tax this year, but in other years, are there investment thought? Do you have any thoughts from an AGI perspective on making those investment decisions when you do want to avoid the income tax question?
Well, and I think it's like they just said, anything that makes sense for the operation. So if I'm going to be doing that, I want to make sure I'm able to store it in the best possible condition, because there's nothing worse than delaying these payments or not delivering on grain and holding it on farm to hope for the better opportunity for pricing in the future to have it go out of condition. So, from that perspective, it's really about making sure that all the structural integrity of the storage facility at the operation is in the right condition to be able to hold that for as long as you may need it to be. So,
All right, I think that makes sense. And so another question, and I'm going to read two questions because I think they're kind of related. And Gary, Nick, I think this is kind of more in this crop insurance area, but if higher crop insurance coverage costs are being used to justify your higher cash rent, and the lender does not require you to carry a certain level of crop insurance, what is the minimum coverage a farmer should carry? 70, 75%, et cetera. And at what point does lowering coverage make financial sense? And then a related question, how low can a farmer go on crop insurance coverage before it becomes too risky, especially when rent is high? So maybe break down those questions a little bit. There's a lot there, and what are your thoughts, guys?
yeah, that's a good question. So I'll start here and say, if we're looking at Illinois in the northern and central part of the state, we're looking at most farmers taking 80 and 85% coverage levels. And then in southern Illinois, probably 75 to 80%, or just the cost of the premium goes up in southern Illinois. If I were talking to a farmer, I would. It's hard for me to think about lowering coverage levels on corn because of drought concerns. I mean, we're going to have a drought someday. Probably not this year, but I would give it, like a 1 in 20, 25-year chance, and we could argue about that probability. The one where you may begin to look at that is on soybean side, where those drought concerns are less. You might be thinking about lowering it there. Having said that, though, the other thing that's going on this year is we have ECO increasing its premium support or subsidy from 65 to 80%. and just given the pricing of those policies, if you subsidize at 80%, over time, farmers should make money buying that product. So part of the reason why Illinois farmers are asking those questions is we probably have too high rates for the combo product. We probably have too high rates for the ECO too, but it's kind of hard to mess up so much that you screw up an 80% rate. So I would be thinking more on soybeans lowering it than corn, and I would still be thinking sort of looking at ECO. So Nick,
Yeah, I mean, we'll be running some scenarios and we'll be putting information out about 2026 crop insurance decisions on Farm Doc as we get into the price discovery period in February. But I think especially on soybeans, I think again, given the environment that we're in, I think there's going to be farmers who've got some crop insurance coverage scenarios that they should look at where they might be lowering individual coverage levels on their underlying product, but then taking advantage of those highly subsidized add-on products. And 3 years ago, what SCO was introduced in the 14 Farm Bill, 15 crop year, ECO was 2021, I think. I think when those products were introduced, we were hesitant to really recommend substituting individual coverage for that area coverage because there's the risk that your farm's going to have a loss and the county product doesn't kick in. But like Gary said, with that 80% coverage rate, finding ways to try to reduce per acre costs, you can probably put together a pretty high coverage level combination of underlying and add-on coverage that might be cheaper than what you've been paying for 85% RP in recent years. And I think it's something in this environment you might want to take a look at. So.
Yeah, I'd agree with that as well. I know, to Gary's point there with the ECO, that was something I looked at for my operation this year and just kind of found that balance of which is better, my higher coverage level or a moderate level with the ECO coverage. And that's how I approached it. And, like as is with any other year, insurance is always too expensive until you need it, right? So, and then luck would have it. In my part of South Dakota, we caught early frost in September, so that'll probably pay some dividends for us here this year. But yeah, just again, it's just like anything in ag, running your numbers a few extra times will probably pay off in the long run when you evaluate things that way.
That's good. And so I'm going to transition to some of the pre-submitted questions while we get a few more submitted here live. One of the questions, and I think all three of you might be able to speak to this because we've kind of already talked about it a little bit, but what do we think the real impact of the submitter said ad hoc / Trump / administration payments will be on investment decisions or the ag economy? And so that's a big question. I'll let you guys run whatever direction you want with it. Gary, why don't we start with you? What are your thoughts there?
yeah, so those ad hoc payments, I mean, and Nick, correct me if I'm wrong, they're going to be 40 each dollars. What did you eventually say they were going to be?
Depending on your crop mix, 35 to low $40 per acre on average across your farm.
And we saw something similar to that with ECAP, by the way. And then, by the way, we've had ad hoc payments for a while now. CFAP was around, MFPs were around. So they do fill holes, right? You will take those $35 payments in February or excuse me, March, and they will fill some cash flow holes. Here's the negative: is that they cost would be lower without those ad hoc payments, and the prime example is cash rent. I mean, your cash rent landowners, and we had a discussion of that yesterday. Where the landowners know that those are happening, and the cost reductions that we need to see so we don't need those payments are forestalled by those payments themselves.
Yeah, and I mean, the bridge payment, we don't really have details on how USDA calculated them exactly. But the information that was provided said, it was based on an average return estimate for each crop with cost of production estimates and yields and prices from USDA. And so, we can kind of put those numbers together, and we did. We put some early estimates out in December, and we're pretty close to what those final payment rates were. And they're basically covering about 30% of the estimated average at the national level loss that USDA numbers suggest for each of those row crops. It varies a little bit across crops, but it's about 30%. So it's not completely filling the hole, as Gary said, but it's a sizable portion there of that negative return. We're looking at another big payment expected in October from Mark and PLC. And I guess, one of my questions about this thing, in addition to the longer term impact on costs and where we'd be without them, they're, it's easy to say we have lower costs in the absence of these things, but structurally, where would we be too? Like there'd be some farms that probably wouldn't have made it. And that would have led to more consolidation among the farms that were better positions going into the current downturn. But so I think it would just have accelerated things that are already happening. Another issue with the bridge payments that I've thought about is, everybody's getting the same thing. And, we can't necessarily want a system where the people who did the worst are the only ones who get the money. But think about what it does. It's undercompensating some of the farms that are in severe financial stress. And it's also giving payments to farms that are in good positions. And again, we shouldn't penalize people for making good decisions historically and being strong financially. But I think that also contributes to, rising land values, higher cash rents, because there are farms that are going to continue to be in a position to be able to pay those prices, whether they're buying farmland, buying equipment, paying high cash rents. So there's no easy solutions to these points I'm bringing up, but I think they're things we should think about.
Yeah. Yeah, and I'd say, based on conversations I've had and some of my coworkers have had that we've discussed it, again, the payments aren't filling the holes, but they are allowing a little bit of a chance to breathe. And I think a lot of the growers that we've had conversations with, they have their budgets fairly in line, have an idea of what their budgets are, then these type of payments come across, and it gives them an opportunity. What we're seeing is an opportunity to look at, again, the farm infrastructure and look at the things that they perhaps were going to upgrade or add on to in 2025 that they held off on because of the uncertainty that was out there. And now that that harvest is done, things are accounted for, see what could or could possibly be coming up here. It's given them a little bit more, I guess, peace of mind to go ahead and make a decision on, okay, these are like my top 3 to 5 things that I wanted to improve operational efficiency for the operation on. That's where that money's going to go for 2026 to try to avoid being as tight at the end of this coming year as it was in last year. And just as we do with everything, just constantly looking at things to improve overall operational efficiency on the farm again. So that's going to be a number of things from storage, the monitoring systems, to you name it. But a lot of the conversations haven't gone around just going out and buying this or buying that. It's been about investing it back into the operation, make it more efficient.
No, I appreciate that. I think that was kind of a hard question. I know it was a really broad question for sure. Just switching around here, we'll go to one of our live questions. We all wish we would have purchased more farmland after the price dip in 1980s. Yet at the time, it would have seemed like the economics would not have supported that business decision. Are we seeing something similar now? I think that's a great question. What are your guys' thoughts there?
No, there's no there. The best time to buy farmland is 20 years ago, right? And it's always been that way. It doesn't cash flow. It 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 never uh, it never has. So and that's just the nature of the beast here. I guess the thing that might give you a little bit of pause now, though, is that there are going to be a bit of downward pressures on farmland prices as we see cash rents decline. And again, I'm not expecting a large movement down in farmland prices, but you can't also see them increasing much for the foreseeable future. So that is one thing that's going on now. In just in the 1980s and 1990s, we could use funds from cash rented farmland or rented farmland to help with those purchases, and it's harder to do that now. So, and actually, we're going to be talking about that tomorrow. So, uh, yeah.
Yeah, and
Oh,
I guess I'd look at it from the standpoint too. I think back to 20, the big drought of 2012. Then we had the big commodity price increase there in 13, 14, and land prices skyrocketed. You hear it time and time again that land is always too high when you're looking to buy it, and they're right. But again, look back 20 years, you wish you would have bought more. When guys were buying land in 2013, 2014, and people shaking their heads at the high prices that they were paying, yeah, we probably saw a slight decline the year or two after that. But I know for a fact the land prices that they paid that day in 2013, 14 are the value is higher than what it was then. So, I mean, land is not a short-term decision, right? It's a long-term investment, and it's like anything else we do. You bite the bullet and you find a way and uh, sharpen your pencil every chance you get. So,
that's fair. So if we transition topics a little bit, Nick, you talked a little bit about interest rates. One of the questions we got, and I think this kind of relates to making investments and taking out loans to do that. One of the questions we got pre-submitted, what are ag lenders telling you about their portfolios? I don't know how many ag lenders you talk to directly, but what ag lenders telling you about their portfolios? Any concerns and or I guess the idea here is new lending requirements as we go into 2026?
Um, well, I would kind of categorize that into two types of lenders. Yeah, we talked to lenders. This is all based on, what we would call anecdotal evidence, small sample sizes. I haven't talked to hundreds of lenders. I've talked to a handful of lenders, but if we look at folks involved with the farm credit associations that serve Illinois, I think by the very nature of the farm credit system, I think the majority of the borrowers in the Farm Credit Illinois or the CompTIA portfolios are probably still in pretty good positions. Um, that's part of the lending practices that they use and the underwriting standards that they have going into a loan, even in good years. But there are also some, I think, much harder discussions happening with lenders during the renewal period that we're in for operating lines. Um, a little bit different message from some of the commercial lenders I've talked to. In fact, we were doing some meetings kind of early mid-December here before the holidays, and we were presenting some numbers and kind of made some comments that there are some farms in stressful situations financially, but by and large, the averages in the sector and in the state or whatever are still pretty solid and much better than they were in the early 80s. And one of the breaks, some commercial lenders kind of basically said our numbers were wrong. So, but again, I think it's for a lender, they're working with and worrying about on a day-to-day basis, kind of that left tail of their borrower portfolio that is in trouble, and we don't want to downplay that, but I still think it's a, I don't know if I want to say small, but it's less than a majority of operations that I think are in seriously poor credit situations. They're out there, but there's also plenty of farms that are still in extremely strong positions. So is that accurate, Gary? The things we
No,
look
I
at?
would, yeah. No, I would agree with that. What is sort of interesting about this time is from a profitability standpoint, it is not good. Um, um, and particularly, if you're looking at some of our series that we show for cash rented farmland, those returns have been poorer in the last 2, 3 years, and we've seen them since 2000 and the 1990s. But when we look at liquidity and solvency, we saw a lot of farms that were pretty responsible with, or not, or yeah, took those higher incomes in 21 and 22 and built some pretty good reserves. So yeah, no, so that's sort of where we're at.
All right, so I'll transition a little bit here. We talked about investments. Gary, you shared a lot of numbers on investments when it comes to equipment, but you also shared kind of what I would call infrastructure investments. And you mentioned grain bins, you mentioned tile, but I would transition Ryan and just invite you to share when you think about infrastructure investments, maybe when you're talking to farmers and you're in a position where you're talking to farmers and trying to get them to make some of these investments, what are your thoughts? What are some specific examples of these infrastructure investments that farmers could be making right now, considering maybe the current economic climate?
Well, again, it just goes back to what works for the operation, but we've been seeing, and we typically do see this historically, when we get in a period of lower commodity prices, grain bin sales go up, right? Everyone's going to not want to just give their grain away, and they want to store their way out of it as much as possible. So that's something that we've seen this year. I think the other things that we've seen too is kind of prepping ahead of harvest, knowing that this situation was going to drag on a little bit. We saw a lot of folks just make upgrades to their existing grain bins. So whether that was putting in new floors, new unloads, updating the fans and vents, things like that. Those are a lot of the big things that we've looked at. A grain bin in general is just a overall good investment for the operation. It's a large investment, just like land, but it does pay for itself over time. And now you're seeing more folks, and it kind of comes to one of the topics yesterday, one of the comments yesterday was more about focusing on improving overall efficiency or getting more, finding that more profitable yield level than just shooting for the highest yield for the farm. And you're kind of seeing that with how growers are storing their grain. They're looking at how can they maximize that storage, not just to hold the grain, but actually improve profitability on it. And one of the things that we've really seen accelerated interest in is bin monitoring systems for the bins, whether it's a new bin or a older bin. Because like I said, I look outside my window today, it's 50 degrees, not typical for this time of year in my part of the world. Less than 30 days ago was 10 below. For when we don't have a lot of room for error when our prices are at this level, and keeping that grain in good condition is key to trying to squeeze out any profit when we go to sell here in the future. So a lot more growers are saying, I want to look at improving my efficiency on the acres I have versus getting more and getting more out of the equipment that I already have on farm. And that's where these monitoring systems seem to, in utilizing technology of looking at that grain and telling the fans when to turn off and on, whether it's to hydrate soybeans or just make sure we're not over drying that $4 corn in the bin, are paying dividends back to the operation that way. So that's where we're having a lot of our conversations, is just looking at where's the best place to spend those few dollars that you have to make improvements on. And evaluate the bang for the buck to get back out of it.
Appreciate that, Ryan. And I guess I would maybe just follow up with like a question along the lines of what is one thing a farmer should be considering before they make these investment decisions? And Ryan, we'll start with you, and then maybe Gary, Nick, you guys could add a little thought there. Um,
Oh, again, like anything else, what's the return going to be? It's always number one. If I'm gonna spend a few dollars, how fast is that money going to come back to my pocketbook? I'm not just spending money to spend money. So I think that's the biggest thing is evaluating your return on investment. Term that gets used over way too much, but it's relative. We need to look at if I'm spending money, how fast is that going to return itself back to me, and in what ways is that going to help me out in the long term? And I think that's the other thing is looking at these things. What is the future outlook for the operation? If I'm in my twilight years of my operation and 5 years or less left, maybe I'm not making that investment. But if I'm 45 or less and going to be in it for another 20 plus years, that's something that makes sense to me. So again, how does that fit in? How does it return, and how does it fit into my long-term goals for what I'm looking to do with the operation?
No, I would agree with that. And again, when you're making investments, you got to look at your financial position and see um, what this will do to your working capital and how much, if it's a significant investment, what kind of risk position that does put you in. I would suggest that in this point in time, you want to be looking at investments that have a return or quicker return more now than a couple years ago.
Yeah,
And
I would just reiterate
sorry.
something Ryan said. Sorry, Ryan. But he kind of made the comment about sharpening your pencil and run. I think what he said was kind of looking at running some scenarios. I don't think when we talk about comparing investments that have a positive return or not, there's no guarantees, right? It's all going to depend on the conditions that we see in the next 2, 3, 5, 10 years, and just make sure that you're making decisions that don't require some unrealistic assumptions to play out to get those positive returns. Because I can put pencil to paper or a spreadsheet and show you how something could work out, but are the conditions you're assuming to make that work out something that's realistic? And then on the risk side, we don't like to think about bad outcomes, but what's the likelihood that it won't work out, and what's the risk you run that something doesn't pencil out like you think it will, and what sort of position does that put the business in? Um, I think has to be weighed more now even than in usual circumstances.
Yeah, and I was just going to add there too. You both touched on it, risk, and in conversations we have, that's a high topic that comes up because, especially again, nothing's cheap anymore. You're looking at perhaps a grain bin or a monitoring system upgrade to one of your bins, and when looking at that though, you're looking at okay, a grain bin, and the question comes up, well, am I better off buying a grain bagger type of deal? And if you're looking for short term short-term return, maybe so on the bagger, but again, how does that fit into your long-term plans of the operation? And this isn't to say a bagger is a bad decision, but there's still that inherent risk of if I have grain in a bag versus a steel structure, I have higher risk when that grain's in a bag, whether it's in my yard or 20 miles down the road in the field where I left it, from all the things that can happen to that bag, and all of a sudden all that grain is on the ground and I have to make a quick decision. So again, risk and return on investment and long-term plans, that those are the things that we really need to be looking at, I feel.
all right, I think that's a great place to end today. We're up against the time limit. I want to thank everyone for participating today and remind everyone that we have the opportunity for one more webinar looking at rethinking off-farm income with Gary and Nick tomorrow. And that's going to be maybe one of the better ones of the three. And so I invite you all to return tomorrow, same time, same place. Thank you very much.
Pressure's on.